Well, it's midwinter in Sydney. School holidays are on and plenty of people are either chasing the snow or soaking up the sun, and good on them. But back here in the real world, something is shifting, and while many are tuned out, there's a lot unfolding that's quietly shaping the Sydney property market. Well, firstly, consumer confidence plummeted after the RBA surprised the markets by holding rates steady, yet last week Sydney's auction market delivered its best result for the year. Well, g'day folks, it's Matt Hayson here with The Word, dissecting everything impacting Sydney's property market for the week. As you know, 90% of economists got the RBA rate call wrong. Barrenjoey's Andrew Lilly summed it up. This is the fifth surprise for the RBA in the last 3 years. I reckon there are more. And now it is a reminder though that the forecasting system is broken and the fallout was immediate. The ANZ, Roy Morgan, weekly confidence index dropped from 95.6 down to 92. Now to put that in perspective, 100 is considered neutral and we haven't hit that under the current government. Now that's 3 years stuck in pessimistic territory, the longest stretch this century. And Westpac's consumer index confirmed very much the same story. People, we want to feel better, but we're not buying the recovery narrative, not yet anyway. And we're not going to until wages lift, costs ease, and the signals start making sense again. Now, while confidence across the economy is very much fractured, Sydney's auction market just delivered its strongest result for 2025, right in the heart of winter and during the school holidays as well. According to SQM research, the combined clearance rate for the week was sitting at 55.5%. The Sydney clearance rate on the Saturday was 59.9, the highest for this year. It's not boom time style behaviour, but it's certainly a meaningful shift and something we should be paying attention to in a period where volume usually drops and momentum can soften as we move through winter. But the buyers, they showed up. In our view, the takeaways are buyers are very much engaged. The market is functioning. And in this climate, that's the kind of resilience that absolutely matters, because we've been saying this for months. This is a measured market. It's building. It's not a FOMO market that some of the headlines are pushing. Now, we've got to dive a little bit deeper into some of the current underneath things which are happening this week. Ken Henry, the former Treasury Secretary, isn't calm. He is seething at the National Press Club this week. He warned the biggest threat to future productivity comes from nature itself, more specifically its destruction. Approval times for major infrastructure projects have absolutely blown out. Environmental gridlock is stalling progress and it's costing us. Australians have lost circa $500,000 in potential earnings over the past 25 years due to our poor productivity growth. We are absolutely choking on red tape, stuck between slow housing supply and absolutely broken systems. Also this week, according to Cotality's latest data, Sydney's current dwelling to income ratio is sitting at 9.7 and it's forecast to hit 10.3 by the end of 2026. That would be the highest in history, and Sydney remaining the least affordable city in the country. Now wages, they're only forecast to go up by 3% next year according to the RBA, but Sydney property prices forecast to climb as much as 13% by the end of next year. That divide between wages and real asset values continues to stretch that access gap. But here's the irony. Inflation seems very much entrenched in the RBA's target range, but the sentiment hasn't budged. Now, why is that? It's because, in our view, trust is broken. After years of mixed signals, rate shocks and forecasting misses, people aren't watching policy anymore. They're watching their wallets. And still, this market moves. This week alone, CobdenHayson are very happy to report that we've just quietly reset two suburb records. The first one at 64 George Street in Leichhardt, selling for circa $5 million, and 145 Denison Road in Dulwich Hill, selling for circa $5.5 million. Both really strong campaigns, sold prior to auction with solid interest and very clear buyer intent. So where are we with this market? In our view, confidence still fractured. Prices modestly improving. Buyer behaviour, well, it's becoming more focused. And the media noise, well, it's louder than ever. In our view, we're nudging on the CH Market Mood Meter this week, 6.5 out of 10. It's our highest rating for the year. The market, in our view, is stabilising. The structure is very much improving, but the headwinds still exist, especially around trust and affordability, where in our view, a sentiment market, and sentiment, like the wind, can shift quickly. A rate cut, it lifts it. A pause deflates it. But with 2 more rate cuts forecast this year, much of that noise should start to fade and confidence may return to the driver's seat. August could very much be a real window for sellers to step in, and buyers, this is the moment to get focused, get aligned, and secure a quality property while the clear field is in play. So that's a wrap for this week, folks. Plenty going down in and around. I wish the Wallabies the best of luck as they take on the Lions in Brisbane, and I'll catch you all next week.